In essence, negative yielding bonds mean investors pay more than the face value of a bond plus interest payments, thereby accepting a guaranteed loss if they hold it to maturity. First, we need to understand the relationship between bond prices and yields. All bonds trade at a price which is inversely related to its yield. In simple terms, when a bond price rises, the yield falls. When a bond price drops, the yield rises. Governments and companies regularly sell bonds that pay a coupon or fixed rate of interest over the life of the issue. If a bond is sold with a coupon of say 1% and the price is set at 100 or par, the yield is 1%. Should the bond price fall below 100, the yield will rise, while a price above 100 during the life of a bond means investors who initially bought that issue now have a capital gain. Well, for banks, buying that German 5-year at minus 0.08% is better than placing their money on deposit at the European Central Bank, which currently has a minus 0.02% rate for deposits. And now that we've mentioned the ECB, we can elaborate further, and this really gets down to the major burning question here. The central bank plans to start buying massive amounts of bonds in the coming months in order to jumpstart the Eurozone economy. So there is a very good chance bond yields will fall further into negative territory as the ECB and other central banks buy up huge amounts of debt. That will push prices higher and means investors will reap a capital gain that offsets a negative yield.